The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. Here are your headlines today. The S&P 500 closes higher for the fifth straight day as US consumer inflation comes in below 3% for the first time since 2021. Michael Burry and David Tepper bet big on Chinese tech names in the second quarter as a number of top hedge funds cut their Magnificent Seven exposure.
Japan's Nikkei pushes high after GDP tops expectations in the second quarter, growing over 3%, setting up the Bank of Japan for another rate hike. And calls grow for yet more stimulus from Beijing after Chinese factory data disappoints, with the slowdown overshadowing an otherwise positive bounce in retail sales.
Big focus on the data yesterday. The markets are clearly concerned in recent weeks about just where their positioning is around Federal Reserve rate cuts. And so some sort of evidence in the data clearly being sought by investors here. Now, the US consumer price inflation came in below 3% for the first time since 2021 in the month of July, clearing a key psychological level as investors look to see when the Federal Reserve could join its peers in Europe and the UK in cutting rates from their highest level in more than 2 decades. The US central bank has held rates at around 5.5% for more than a year now, choosing to hold rates in each of its last 8 meetings. But traders have now trimmed their bets on a 50 basis point cut since that CPI reading, which came in line with expectations, not under them like Tuesday's PPI print. That's according to the CME's Fed Watch tool, which shows investors lowering bets by almost 20 percentage points. Either way, it's a winding road to the next Fed meeting with 4 key market events on the horizon before the month is out. Starting with retail sales on Friday. Next week, we get the minutes from the Fed's July meeting before central bankers convene in Wyoming for Jackson Hole before the Fed's preferred PCE inflation metric hits the tape on the 30th. Look at those US markets. Unconvincing stateside on the Nasdaq in particular. Barely any movement really during the session. No one jumping in to scoop up stocks here. And don't forget, there was the alphabet hangover where investors were looking at the regulation that could be coming Google's way. So that was a bit of a downweight for the Nasdaq. The S&P 500 picking up 0.4, a bit more activity on the Dow. Its fourth positive session in 5, picking up 0.6%. Treasuries, well, we're off the lows on the back of that sell-off that we saw around the volatility with the carry trade unwinding and concerns around the data and fears of a US recession. So we've bounced off those lows from earlier this month, but we've also come off the recent highs too. So as you take a look at that short end, we are just perched off the 4% handle, 3.96 this morning. As a result, the dollar has been on the back foot versus some of the pairs and crosses in the overnight session. Euro dollar, we're 110.09, but you'll see we have climbed on that rate. We are looking somewhat elevated versus the past year or so when it comes to that trade. Sterling dollar, a few concerns around what the Bank of England could be doing on the back of the CPI numbers yesterday. Morning session, we're picking up some steam, but on the back of a drop, so we're 128.39. Dollar yen, a bit of stability we're looking at here. We're 147.27 morning session.
All right, so here's an interesting one. Atlanta Fed President Raphael Bostic has told the FT Wednesday's CPI print is a very positive sign, saying he's open to a September cut, as Fed officials should be mindful of their double mandate on inflation as well as employment. Just want to remind you as well then, actually, just that on Tuesday, the same Raphael Bostic had said that recent economic data has made him more confident, yes, on US central bank gets inflation back down to 2%, but he wants little more data before he's ready to support lowering interest rates. Then 2 more pieces of data came out. That was PPI and CPI. And that seemed to be enough to sway him to say that indeed he's ready to support a rate cut. All of this does come after his Chicago peer, Austin Goolsbee, said his concern is shifting more toward the labor market than inflation. That's after the recent increase and unemployment. Now, speaking to CNBC, former Fed officials and top economic voices gave their take on what to expect at next month's Fed meeting.
If I had my druthers, which of course I don't, they'd have cut 25 basis points in the July meeting. They didn't do that. So they owe us that, and they're going to deliver it pretty soon, I think.
I think there was actually a pretty strong case for cutting at this last meeting, but not a big deal that they didn't. And I think that they're going to be surely cutting at the next meeting because that's really called for. And expect further cuts after that, as long as the path stays pretty similar.
I don't want Powell to go too slow. Yes, the data came in better last week, but I think the risks are fully two-sided. Why aren't we down?
Kyle Chapman's joined us, FX markets analyst at Ballinger Group. Kyle, thank you so much for joining us.
Thank you.
I started my day reading a high-frequency economics report and saying, look, since the 1970s, there's been effectively 24 times that the Fed has lowered by 50 basis points. And you look at that number, you think, oh, 24 times, it's possible we could see a rate cut of 50 basis points. Then you start picking your way through the different events, from COVID to Lehman's collapse to the dot-com crash to the September 11 terrorism event. You're like, well, quite frankly, we're not looking at that type of event at this stage when it comes to the September meeting for the Fed. So chances of a 50 basis point, we put that reduction over here, don't we?
I think very low. A 50 basis point move is a desperate move, in my opinion. It's what you get in a recession-style scenario, and that's not what we're looking at least not imminently. So, I think the markets are pricing around a 35% chance of that 50 basis point cut. But I think we would need a growth scare from something like the payrolls for the August report to really kick that off.
So looking into the data from yesterday, what we saw in the numbers, the CPI wasn't as cool as the PPI, so it was enough to suggest we're going to get potentially some rate cutting from the Fed, just not 50 basis points. What did you make of some of the stubbornness still in the data when it comes to, say, the housing segment, which has been all dominant?
Yeah, that's very important as well, because the inflation was mainly driven by the lag components, right? So there's shelter, which makes up 34% of the index overall. Leading indicators have pointed to some more progress down the line. I think everyone's expecting that to come down over time. And also you've got auto insurance, which mainly represents a recuperation of losses that they've caused over the past few years. It's more of a catch-up than anything else. So we know that's going to come down as well. And those two marked the majority of the rise, right? So there's very little inflationary pressure throughout anywhere else in the economy. The uptick in rent was important, but I think you can put that down to volatility. I wouldn't be too concerned unless that turns into a trend.
The last meeting, Fed Chair Jerome Powell spoke about how the balances, the risks are balanced on both inflation as well as the jobs market or the overall growth market here as well. Do you think that really is the case, or is it a case now of less inflationary risk being at play now and the focus really being keenly on growth, especially that labor market?
Yeah, I think that's exactly right. I think that you can't say job done, but I think we're all but done. We're pretty much there on inflation. It's no longer an obstacle to rate cuts. I think the pace going forward is going to depend on that growth data. I think the CPI, in particular, single data point, is going to be focused on less compared to where the labour market's going, where growth is going, how quickly they need to sort of introduce these rate cuts to pull the economy up.
Yeah, Kyle, have you been surprised at all, or perhaps concerned by Fed commentary or communication, as it were, particularly in this rate hiking cycle to right now having this higher for longer stance? Because it feels as though it hasn't been coordinated, or it hasn't been structured in many ways, because you'll get varying views at almost every data point. And I point again to Raphael Bostic, as I said a little bit earlier. Just Tuesday, he had been saying that he wants more data before he can support a cut. Then PPI comes out, and then CPI comes out, and then it's all of a sudden enough to warrant, yes, maybe more confident now to cut. Is that worrying that you're not actually sure where the Fed sometimes sits, or is it a case of, well, they're data dependent?
Yeah, absolutely. I think that's a big sort of source of uncertainty in markets at the moment. That is driving volatility from every single data point. I think there is a sort of, or there should be a trend, as you see in the ECB and the Bank of England, where they are more moving towards that forward-looking view, where they're really putting their confidence in the outlook for 12 months' time, 2 years' time, rather than reacting so heavily to every single piece of data. So I agree that it's too much. There's no need for every single piece to completely upend your outlook, and I think that does create unwarranted volatility.
Can I pick up on the volatility which is spread to FX markets? We saw it in a dramatic way with the carry trade unwinding, the impact that had on asset classes globally. What's the most interesting pair for you now at this point, as you mentioned a number of the central banks?
Yeah, I mean, obviously dollar yen was the biggest move as a result of that. But I would probably look more towards my interest would be more into euro dollar and sterling euro. And sterling dollar. Mainly because so the euro dollar is, I think if it wasn't for the fact that we had this hit to risk appetite, we would be able to push towards those 111, 112 levels. I think it's currently underperforming the rate differential because we've had so many rate cuts priced in for the US and the euro dollar hasn't really caught up. I think it took a long time for it to really pierce through that 110 level. But we finally got that over the past few days. I think probably the primary reason for this is because the markets don't really feel like the euro deserves to be that high. I mean,
yeah, that's to that point, just the ranges we're talking about here, because it is fascinating. We almost feel like we're at a tipping point. So the highest level since late last year, but the next stop really was mid-year last year, where we were roughly the 112 handle. Why would we ever return to that level when we are watching much weaker growth dynamics in Europe? ECB also in a cutting cycle now, it seems, even if the Fed gets going. Doesn't everything just look a little bit weaker in Europe?
Yeah, absolutely. I think that's why it's really struggled to, as I said, to push through that 110 handle. And I think obviously it mainly boils down to aggressive rate cut bets in the US. I think perhaps the market has got ahead of itself and they've priced in far too many. I think we're looking at 3.5, maybe 4 cuts this year. Some people are expecting versus once every quarter in the ECB. I think 1 or 2 more probably in the next meeting and then December. I think that in the near term, there's a very good chance that these aggressive rate cuts get trimmed back a little bit, and we do get euro dollar move back towards the 108, 109, where it probably belongs, considering you've got really weak PMI data. The ZEW collapsed earlier this week. It's just there's a very subdued demand environment in Europe at the moment.
I want to touch on Japan, if I may, and particularly just the yen. Yes, we've seen that carry trade story, of course, all of last week, etc. But now, having seen the GDP print, questions are whether there will be another hike in store for rates in Japan, and what ultimately that could mean even for the currency. Is this level stability 147? Is that pretty much stable right now, or should this be perhaps playing at around 141, where it was just as that carry trade was happening?
Yeah, I mean, it appears at the moment that we've had the majority of this, at least the short-term visible carry trades have been flushed out, and that's obviously brought it down to where it is. I think we are at a point now where it's more being driven by macro fundamentals rather than stretched positioning. So we are realigned now with that 10-year US Treasury JGB spread that had been driving the yen for much of the past couple of years. I think if we get a few more BOJ hikes and also we watch the Fed cut rates consecutive meetings, there is the chance that it moves towards 145, maybe 140 towards the last stage of next year.
How do you think corporates are feeling, given the gigantic swings we've had, and most CEOs want a fairly stable currency, even if they've been weathering some pain with a weak Japanese yen on imports at this stage? How are they feeling given the volatility now?
Yeah, I think the Bank of Japan were actually quite spooked by how much the yen actually surged. We had the officials came out not long after the payrolls report that triggered the market meltdown we saw last week, and they tried to walk it back a little bit and tone down the market moves. I mean, they're obviously concerned about yen weakness, but they're also concerned about excessive volatility in any direction. I think that was pretty clear. So. Yeah, I think we've stabilised. They're probably quite happy, but yeah, there was quite an excessive move. Yeah,
it makes it very hard to plan on the numbers, doesn't it, when you're a big Japanese corporate? Kyle, thank you so much for joining us today. Kyle Chapman with us, FX markets analyst at Ballinger Group.
Now, coming up on the show, US tech is under pressure in the latest 13F filings, with big money managers, including Warren Buffett, Dan Loeb, as well as David Tepper, all paring back their holdings. We'll break down the details. Plus, Japan enjoys a big surprise uptick in second quarter GDP, but also in the Asian session, China sees a mixed set of fresh data. And NN Group posting a top-line beat for the first half of the year. We'll go through the full set of results and speak to the CEO, David Knibbe. That's coming up next.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Now, NN Group posted operating capital generation of 959 million euros in the first half. That's ahead of analyst expectations. The Dutch insurer cited strong performance in its domestic life insurance business for the results. Let's speak to the CEO of NN Group. That's David Knebber now, who joins us. David, good morning to you. Thank you so much for joining us as well here. Let's just run through this quarter then. That seems to have been a better quarter than even the market had anticipated.
Yes, good morning. Indeed, it was a strong half year. The life company did well, but I'd like to especially highlight the European business that has been consistently growing. We set a target of 450 million for the European business for next year, and they might even make it this year. And I think what we see underlying is just a strong commercial growth. The value of our new business was up 23%, and that has been a big driver also for these results. So overall, it was indeed a strong half year.
Yeah, very interesting actually on that commercial growth, and I want to touch on that perhaps a little bit later. But I wanted to touch just a little bit as well on overall that inflation moderation in many regions that you operate in. Does that change spending power? Does that mean you're going to see perhaps a further growth in top line from here?
Well, we've always said that we're not so sensitive to the inflation movements. That's really on our balance sheet. We're well protected. So actually coming down then of the inflation also doesn't do so much. If the inflation really comes down over time, that is helpful for our non-life business. We do see upward pressure in claim handling cost, wage costs, obviously across Europe are going up. So if we would be seeing a slowdown of inflation, that would certainly be helpful for the non-life business. But overall, we're not so sensitive to inflation risk.
David, it's Karen jumping in. I recall when you started out the year, you were talking about some of the challenges here, the volatile macroeconomic environment, the geopolitics, and the reality is we've had all of that in spades throughout 2024. How challenging has it been to stay on course?
Yeah, I mean, obviously, there's an enormous amount of things happening in our businesses and also in the region, in Japan, and we are operating in 4 countries that border the Ukraine. So there has been a lot of challenges across these markets, but our business model in general is not that sensitive to it. We really focus on selling protection products. We see a clear underpenetration of protection products in the region, and people are more and more aware that they need to protect themselves, their families, their homes, and that has been a big underlying driver for the growth that we have been showing, and we continue to believe that the market is still very underpenetrated. So despite all these challenges and the geopolitical pressure that we see, I'm actually very happy to see that we continue to reach our customers and be able to offer their good propositions to them.
David, I'm curious as to how you're not impacted in Japan by the recent events. So 28 different cities you operate in. We've seen a swing in JGBs, a swing in the currency, a movement in asset prices in Japan. How are you not impacted by that volatility we've seen in markets?
Well, I mean, obviously there was a lot of equity volatility. We only have 3.2 billion invested in equity and not in Japanese equity. So I think that is one factor. Also, we invest typically more in mid-cap companies. And in fact, during that volatility, our equity portfolio was stable or actually slightly up. So that was not a big factor for us. Of course, rates came down a bit. But as I was saying, we're not so sensitive to these rate movements. And well, to be honest, with the strengthening of the yen and the increase of interest rates is actually positive, we believe, for the valuation and of our Japanese business. So overall, it's a very manageable volatility for us.
David, I want to pick up on geopolitics because all this year you've been talking about the strength that you're seeing in Central and Eastern Europe. In particular, you're picking up on some of the strength you're seeing in Poland, Czech Republic, over to Greece as well. What impact is the war in Ukraine having on activity, if anything, at this stage?
Well, I mean, the war, of course, has at a social level and for people has a tremendous impact. We see a lot of refugees coming to the market, and these countries are really trying to do a good job in taking care and helping the Ukrainian refugees. So at a social level, the impact is very, very big. But, you know, as I was saying, the need for protection, that people want to protect themselves, has been very high. But this has historically always been the case. And I think what is different now is that we're able, with our distribution channels, our tied agent channel, our banking channels, but also the broker channel, and we even see a pickup of direct sales, that through these channels we're in a better position to reach these people. And once we get into a conversation on how well are you protected, then we see an increased need for these products. And I think that started with COVID, when people became more aware on how vulnerable they are. And yeah, with the war in the Ukraine, that trend has continued. So the under-penetration has been there for a long time, but we're now starting to see the benefits also in terms of our sales, especially in Central and Eastern Europe and also in Greece, as you mentioned.
Yeah, I mean, one then could ask the question then, if that is the case, and there's this sustained desire, of course, for protection, etc. As you point out in your numbers, you see sustained growth in Europe with increased sales across Central and Eastern Europe in particular. Then, how much more growth is there then available in Europe, or is this based on seeing kind of elements that would push people for further protection in order to get those numbers higher?
Right. Well, we believe that there will continue to be a growth opportunity in these markets. As I was saying, we set a target of 450 million for 2025, and we might even make that this year. And the underlying driver is not financial markets, but is what we call new business growth. Now, if you look at the numbers, if you would compare any of those statistics to, for example, Western Europe, you still see a very low penetration of protection products. So that means that we are convinced that there will still be a need for protection. We've also seen on the pension side that governments typically are retracting from offering large pay-as-you-go pension systems. Companies in Central and Eastern Europe are not always offering pension plans. They often put that same money into salaries. So we also see a good pickup of the pension business. So the combination of pensions and the under-penetration in protection makes us be convinced that also after 25 and after we achieve our targets, we can continue to grow our business there.
David, I've read the release about 3 times this morning, and I'm still looking for anything around technology in here. I can see there are investments when it comes to climate solutions, telling up to about 11.5 billion euros, but nothing specifically on tech. How is AI going to figure in the performance of the business in coming years?
Right. Well, I'm very happy that you asked this. I mean, AI has been getting a phenomenal amount of attention in our company. I think I would argue we're probably at the forefront in the insurance industry in the development of some of these technologies. We already have what we call automatic call logging as an example, where if people call, we have ChatGPT that runs with the conversation and then can automatically put a summary of that call into our applications. It saves about 4 minutes per call, and if you think about that at the scale that we operate, this is a big savings. ChatGPT is also functioning as an internal knowledge base, so we're now currently putting all of our internal knowledge into ChatGPT, our internally hosted one. And as you can imagine, if you have new people coming in, and insurance and life insurance can be complex business, the value of people getting immediately access to the right answer so that they can help their customers is just enormous. We're using AI also for our tied agent channel, where we're in a better way with analytics. We can steer and lead the agent to the right customer. So yeah, it's been a big journey for us, but I'm actually proud that we're not talking about gimmicks and examples, but the examples that I'm giving, we're scaling across markets, which I think is very good, because we've actually moved from just AI applications to actually implementing it, but also scaling it across multiple markets in Europe.
David, what I'm taking away from this is that there could be a big impact on the customer. So we watch the customer satisfaction levels from here, but also in terms of the actual workforce and the amount of numbers of workers you need to engage with customers. But where does it actually start to have some impact on claims, in the sense that you can price the risk because of the sort of analytics that you're getting from AI, having a dramatic impact on managing risk? When does that actually crop up for the business?
Right. Well, it's happening. It's another example where we use AI. So if people get into an accident or they hit something with their car, they can make a picture, send it to us, and through AI we can already assess the damage, predict how much the claim should be, decide on immediately payout or whether we need to do some additional checks. We can also compare then how much the cost should be. So these are the type of things that we're implementing step by step. Today, what I see is that a lot of the AI applications that we do are around efficiency. So that means that we can do it faster, cheaper, better for our customers. I'm pretty sure that over time, the application of AI will be a lot broader and not just on the efficiency side, but also more on the commercial side. There's probably going to be new opportunities coming. But today we already see this. So more and more work is being automated that we weren't able to do fully through what we used to call straight through processing. But now with AI we can. And it also has an impact on the workforce. That means that the type of work that our colleagues are doing is changing, and I would argue at times become more interesting. But it's certainly a massive change already happening, and it will only get bigger in the coming years.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.